it all goes back to the banks. They are, if whether you like it or not, that is the infrastructure today of how money moves. And when they adopt stablecoins, when they adopt tokenized deposits, when they adopt digital assets and blockchain, that is where mainstream will see its main adoption curve. And I think we're seeing it, right? I can finally honestly say it's there.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of real-world assets. My name is Simon Taylor. I am your host for today, author at FinTech Brain Food and head of strategy at Sardine. Joining me is my co-host, my friend, Kai Sheffield, head of crypto at Visa. How are you doing, sir?
I'm fantastic. Excited to get into it.
Likewise, man. There's a lot of stuff to get through this week. And I just want to remind everybody as well that we do now have a tokenized newsletter. So head to tokenizedpod.com and get subscribed to that newsletter. Joining Kai and myself today is a genuine legend of our industry, Goldi, who is SVP of Payments and Network at Fireblocks. Goldi, how are you doing, my friend?
I'm good. Thank you, Simon. Thank you, Kai. Thank you both for having me. Excited to be in this episode. I'm going to sign up for that newsletter right now, by the way. So thank you for the reminder.
Yes. See, this is why you're the man, the myth, the legend, right there. You know how to promote the stuff. I appreciate you for that. All right, before we get into the show, we just need to remind everybody that this podcast is sponsored by our friends at BVNK. And if you've been listening to this podcast, you've probably heard us say, every business needs a stablecoin strategy. And if you're looking for the best place to start, that's BVNK. BVNK is the leading provider of stablecoin payments infrastructure, helping businesses move money faster, settle globally, and even launch their own stablecoin products. All with licensing and compliance so you can build with confidence. We're proud to partner with BVNK on Tokenized. To learn more, visit bvnk.com. Okay, and now just one last bit before I get into the good, meaty stuff, and then we will get into it, I promise you. I just need to remind viewers and listeners, opinions of contributors today are their own and might not reflect those of the companies they represent. Nothing we say should be taken as tax, financial, investment, or legal advice. It's not even a tarot card reading. So please do your own research, folks. All right, the first story this week we had to cover was the Fed Chair Jerome Powell saying crypto is going mainstream. So he was interviewed in a fireside chat at the Econ Club in Chicago. So some of the key quotes here are, we're moving to a mainstreaming of that whole sector. He's referencing the on-chain sector. Stablecoins are a product that should have fairly wide appeal and should have consumer protections. He also mentions that in the past, they took a conservative approach to guidance that they'd imposed on banks. I think there will be a loosening of that, he said. Those were his words. So, Goldi, give me your reaction to this and in the broader context of, we know there's legislation potentially coming, that we know there's other things going on. What do you think the significance of these comments are?
Look, I think he's reading the room more than anything else, right? I mean, this administration in the US has really signaled to the crypto industry, which one might say are a lot of voter promises that were made during the campaign to get here, and they've been signaling all along that in the last at least 2-3 months, this is changing. The climate in which we treat banks that are going to do anything with digital assets is changing dramatically. As you know, there's two bills right now, right? The Stable and the Genius Act, and one of them is probably going to push through the summer, we hope. And it changes a lot. And if, Kai, I'm sure you agree with me, you probably had a lot of those meetings as well. Over the last 3 months, we've been meeting with, anywhere from GSIBs banks, the globally systemically important banks, to the, let's call that second tier banks, which are huge, right? And all those banks, and you've been preaching about this, they want to start thinking about a right strategy if they haven't done so before. It doesn't mean it's going to go live tomorrow. It means it's going to probably end up being in their cycle and maybe go live in 26. But I think what we are hearing in his comments is look, I understand that this is now the new zeitgeist. And I believe it's not, we're no longer in proof of concept world. We're as an administration, they're pushing that forward, and I'm aligning to that. That's what I'm hearing more than anything else. And I'm sure banks love to hear that.
Yeah, I agree with all that. I think that there were two key takeaways that I had from it, and first, I think it's a good 2-minute articulation of all of the news that we've been covering on the show for the past 6 months. That if you just listen to Powell for 2 minutes, it kind of summarizes all of that. I think it's notable that he's acknowledging that stablecoins have potential, and so these are some of the first positive comments I've seen or I remember from him about stablecoins specifically, while also recognizing the importance of consumer protection and acknowledging that there are bills in Congress that are seeking to ensure that protection is there. So I think it seems to be support from him on the general constructs of the bills that we've been discussing on the show for several months now. And I think the other piece to Goldi's point on he acknowledges that the approach towards bank activity in the space it has been very conservative over the past 4 years, and there's been now he says a likely a loosening of some of the guidance, but not compromising wanting banks to ensure that things are done in a safe and sound manner. And I think that's the really key point, that even if you have OCC guidance and FDIC guidance and others that don't require you to seek a non-objection to be able to test a use case with a stablecoin, it doesn't mean that banks can do whatever they want and they don't have to worry about risk and do things the right way. It just means that we're not going to look at this technology and treat it in a different way than any other technology, requiring different standards to be able to work with it. And so I think all of those comments continue to add more support to the people inside banks who've been looking to innovate and looking to use this technology for several years, that they're now seeing more and more clarity that will give them the opportunity to do so.
Look, I mean, sorry, Simon. Look, I'm not from the U.S. I'm not 100% on everything that's politics in the U.S. But I can only think that for Powell, this is like an easy gift for him to give to President Trump, right? They're probably at beef on a lot of things right now. There's trade war going on. A lot of the times we think, hey, maybe this is something big for crypto. It's actually just one of a bigger political play that's going on, and maybe this is his way of saying, "Hey, I'm with you on some things, not against everything. Let's all align." And I think it might just be an easy gift for him to give away as well.
Yeah, it's low-hanging fruit when you're looking like you're very likely to get legislation, which makes the independent Federal Reserve governor's job a whole lot easier when Congress acts. There's some separation there. But I loved 2 points you made, Goldi. One, he's reading the room. And I think the market has shifted. Like, I think it's now generally accepted that stablecoins are the first killer app of digital assets and on-chain finance. And that was probably not true 18 months ago, 2 years ago. The second thing is, yes, the administration has changed. So to your point, there are needs to accommodate that no matter which branch of government you're in. So that's also reading the room. But the removal of the no action letter that Kai mentioned, I just want to underscore that point a couple more times. If you were a bank and you had to go seek a no objection letter before you did anything, that's an incredibly high bar to do anything. That going from the OCC, from the FDIC is huge. Now, this comment, regulators do a lot of regulating through signals, through what you see in the headlines. And this was an knowing comment where it was fairly obvious this was going to make headlines in the crypto press and therefore the financial press, and therefore bank CEOs were going to see it. So I think, as everything that the chair of the Fed does, there's so much of it that is about quietly, gradually signaling through headlines what the future might be. So from the chair of the Federal Reserve to a bank far, far away from that, Standard Chartered, headquartered in the UK, but very large in Asia. Standard Chartered has said that the market for stablecoins will be worth $2 trillion by the end of 2028. So for some context, today, as we record this, the total market cap of stablecoins is around 230 billion. But they believe that the passage of the Genius Act in the US could lead to a massive jump in stablecoin supply. And that has massive implications in turn for US Treasury buying and dollar hegemony. So a 10x in 3 years, that's pretty big growth. Goldi, are you seeing things at the front end that say that that's possible? Is this just like wild speculation, or are they even undershooting it?
Yeah. So look, I mean, let's unpack this for a second. What does it mean? It will be 2 trillion, right? We know right now that the cross-border, market globally, if you try to put a number on that, that's probably 150 trillion a year easily. And we're probably discounting China and a lot of things that we're not seeing, right? So is he saying that the volume will be 2 trillion, or is he saying that, the overall market cap of money will be 2 trillion? I think probably both of them are right. Today, just the fact that we have, money today is considered to be just money out there. Let's say US dollars considered to be, I believe, up to $100 trillion, right? How much is that is going to become a stable coin? 2 trillion? To me, that sounds like next year's figures. It doesn't sound like this year's figures, right? It sounds like, yes, of course it will be 2 trillion. We're on the verge of, we're probably going to talk about this later. JPMorgan coin, or their new initiative, and we'll talk about their new name later. Is that considered a stable coin as well? Is that a tokenized deposit? So there's a few things to unpack when he says that. And there are a few things that are hidden there. And I think we need to remember that these banks are not necessarily in favor of stablecoins. I'm not saying they're against. I'm saying that they see these stablecoins, they understand the value that people are benefiting from them right now, of moving money faster, way more predictable than they could before for cross-border payments more than anything else. But is that the best product that banks want to actually put up there? A stable coin that does, this allows them for doing fractional reserve? It's a tough question, right? So when he says that, I truly wonder in the back of my mind, is he setting it up for creating tokenized deposits that could be used between banks? Would that be worth 2 trillion? Right. So that's what I have in my mind. But when we go back to thinking about the number itself, for me, that's like a 2025 number.
Yeah, this is specifically about stablecoin supply, right? So the report from Standard Chartered says stablecoin supply was going to 10x over the next 3 to 4 years. They also said, this is the other interesting stat, that would lead stablecoin issuers to buy $1.6 trillion worth of US treasuries for their reserves. So some interesting stats in there, but I love the fact that you'll say that this is like a 2025 thing. But yes, we should separate the supply of money from the velocity of money. Like a dollar can move backwards and forwards between people 100 times, but it's still $1. So the supply is not the same as the processed volume, as we'd say in payments land, Kai.
Yeah, we've been spending a bunch of time on on-chain data, and really we think any discussion around stablecoins, it's important to ground it in the data. And it's great that there's a lot of data that's out there that you could see that you can analyze, so you don't have to guess. And I think that the two numbers and metrics that we think are important for everyone to understand is, supply is one. How many stablecoins exist in terms of the overall value across every stablecoin out there, and that's what's about 220 billion right now. And then how much volume is actually moving in terms of transactions going over blockchains. And if you look at the volume number, by pretty much any account, it's significantly over 2 trillion today. I think if you look at the raw data on a blockchain, it might be as high as 30 trillion. we've done some adjusted methodologies, taking out some of the high frequency trading and automated bots, and that brings it down to around 6 trillion. But you're still in the multiples of 2 trillion in the volume. I think what's interesting about this prediction or this report is going from 200 billion. I think a lot of people are surprised even that we're at 200 billion right now. When we talk to banks and we're like, did you know there's 220 billion in stablecoin supply? They're like, that's a lot. Like it seems for a new technology that most people aren't really well acquainted with, 220 billion, seems like a decently big number to start. To go to 2 trillion by end of 2028, that's pretty quick growth in a market like this that is a new technology that a lot of banks aren't familiar with. And so I think that we're going to see more and more banks get acquainted with on-chain data and start to track this and follow it. And then you got to look at, okay, well, if stablecoins monetize based upon interest income, and if interest rates are going to come down, you kind of have to believe that the supply is going to go up if they're going to make money. If supply is going to stay at 200 billion, maybe it goes to 500 billion, how attractive will stablecoin issuer businesses be? Versus if you get to 2 trillion or 3 trillion, even if interest rates come down, there's still significant growth in revenue. So I think these are critical metrics for everyone in the space that's coming into it to really understand.
But Kyle, let's break this down for a second. Simon, you said he's basically talking about the M2 money supply, right? So that today in the US should be about $20 trillion, give or take, right? 20 to, $23 trillion. Now, he's saying this stablecoins will be 10% of that, right, in terms of market cap. If we're thinking of where is that money really stored today, right? It's stored in obviously various bank accounts of retail, of corporates. And then the question comes, we're seeing what's happening in banks. If we believe, and this is, I think we all have signed up for this. If we believe that over the next 6 months, then 9, 12, 24 months, banks will turn their, the funds that they're holding into a form of a tokenized deposit or a stablecoin. Let's just stay fluid maybe on that definition for now. Let's say they're the same thing for his definition. Then would that cover 10% and come to 2 trillion? I think that would be fairly easy. Yes. Right. But again, it all goes back. And I think I've been saying this, Kyle, you've been hearing this from me for the last 6 years. It all goes back to the banks. They are, if whether you like it or not, that is the infrastructure today of how money moves. And when they adopt stablecoins, when they adopt tokenized deposits, when they adopt digital assets and blockchain, that is where mainstream will see its main adoption curve. And I think we're seeing it, right? I can finally honestly say it's there.
I was going to say that I think the other point that's important here is when you think about the total addressable market, for stablecoins, like one easy way to look at it is demand for dollars outside the United States. And so then you say, okay, well, how much in physical dollar cash is outside the US? I think it's close to $1 trillion. And you say, okay, well, like what's the value of dollar deposits outside the US? I think that's something like 13 or 14 trillion. So you could get to like there's 15 to 20 trillion dollars in dollars that are currently held outside the US. And so then if 2 trillion in stablecoins, could stablecoins end up becoming 10% of dollars held outside the US? I think that seems to be a possible outcome, and who knows? But I think it's the market is more outside the US. I think if you're talking about if you include tokenized deposits with banks upgrading to blockchain infrastructure representing existing deposit, then it's a much greater number. But I think specifically to that prediction, if you keep it just to stablecoins that are a product separately defined from a deposit, I think you look more at like what's the dollar demand outside the US versus just all the money in US banks of like what percentage gets converted over to a blockchain ledger instead of a core ledger. But Simon, sorry, I catch up.
No, I think that's an interesting view, but it's predicated on the idea that the value proposition remains the dollar outside the USA. And actually, the Genius Act is, I think, what they're talking to here as being the inflection point, whether it's banks or not. I think there are several ways you could kind of get to that 2 trillion number. One is the growth that we're already seeing. And I think we're all in the industry. We see those growth rates. If you were to extrapolate out the current growth in stablecoin supply, maybe you don't get there. So you do need this legislative inflection point to bring a wave of liquidity in. But what's fascinating is then the domestic use cases start to open up. And the use cases for stablecoins already in the crypto markets in the on-chain finance world run the gamut. They go from high frequency trading right through to remittances for the unbanked. And we haven't really had a payments rail, a payments type where that's been true before. And so this is really what makes stablecoins the rail that connect above all the rails. It's like the internet for money, genuinely, the internet for payments. Just as the internet did to networks, you still have internet service providers, you still have like modems and routers and payments networks, but you now have this connective tissue that sits above them that suits many use cases that becomes a way for the dollar to kind of travel. That, on a domestic basis, could unlock the replacement to prepaid cards, because the same as cash accounting is different. Unlock, the subject near and dear to your heart, Kai, amazing things merchants could do with loyalty and instant redemption, and kind of how all of those tokenization stories start to fit together. And if you think about everywhere there's an app like a Target Red and Starbucks and all of those sorts of things, what would that look like on stablecoins? These merchants start to come into the conversation, and the banks want to serve those big merchants. And I think that really does start to change the nature of the discourse.
Goldi, I'm curious how you think about that, because I think there is a world of, here are the use cases we see product market fit for stablecoins in today, and that's like screaming product market fit, and that's cross-border payments, dollar access outside the U.S. Then you have a number of future use cases, some which Simon mentioned, around merchant loyalty. What if your Starbucks balance was a stablecoin, like that may end up being domestic? Like, are you seeing any of those use cases play out on the merchant side? Like, do you think there is a domestic loyalty and payments market that is emerging for stablecoins that like has big upside that just is it here yet, or do you think it's going to continue to be cross-border or dollar outside the US as the main use cases that are driving growth outside of crypto trading?
Yeah, that's a good question. I think I honestly think that it's going to continue be in the back end. And I think that every time we bring blockchain closer to merchants, they are like, yeah, that's great, but can I still run my store? Or I need to take care of my business. Now, and again, because for them, especially now that I really believe we've sort of like crossed the chasm, they don't want to talk about these benefits. They don't want to talk about this blockchain thing. They don't, they definitely don't want to talk about, I don't know, Ethereum versus Solana, right? And how these benefits of confidential transfers can assist their business. They do not really care at this point. They're just trying to make their business work, right? Now, if you come to them with a solution that's like great loyalty, and behind the scenes, maybe, yes, great. But to be very, very honest, Kai, we've seen like the hype of those, reward programs on blockchain, and it didn't stick, right? It didn't stick. It was just too complex at this point in time. I think for now, the world of blockchain, specifically when you get more to the, retail side, let's call that, or even merchants, it's just still not there in terms of the solutioning around it. It is there, as we all know, for money movement, because it's the payment companies and the banks that have been, basically the solutions have been tailored for them up until now, right? If you go to platform companies, you go to like service companies that do payments over blockchain, it's being tailored for money movement, really. And that's the product market fit. I do not see, even in 2025, the year of blockchain reward programs being behind the scenes of like large enterprises. Maybe.
I want to challenge that on one basis, because I think I may have been misleading. I don't think this should be a blockchain rewards program at all. Stablecoins at their best hide the wires and are money movement, as you rightly say. So what if there's a more efficient, cheaper, more balance sheet efficient money movement product than a prepaid card, than a store value account? And if you have that and it makes sense on a spreadsheet, why wouldn't you use that solution as Starbucks, as Target, as somebody else instead of the prepaid card, instead of the something else? And I think that's an accounting story that I've found fascinating. Maybe we do a deep dive on it at some point, but I just think there's a whole conversation there.
Yeah, I was gonna say, shout out to Alex Johnson. He had a great podcast, that talks about some of these use cases and like how to think about stablecoins related to prepaid card. Like I was gonna say, like it's almost like if you zoom kind of all the way back, like high level, there are like really just a few different outcomes that could happen if stablecoins matter. One is that all stablecoins get abstracted away into the background, and this is just a modern kind of ledger technology that anyone can use behind the scenes. You just see dollars. You don't know what the stablecoin brand is. You don't know what the blockchain brand is, but you've got fintechs that now have these super powered ledgers that are more efficient for storing and moving value. But it's all back end hidden wires behind the scenes. So I think that's one option. The second option is they coexist, where you've got stablecoins as a back end technology behind the scenes, and a maybe small number of stablecoins that are consumer-facing brands that are used today, like USDC and USDT, that become a product that consumers know exist and have some preference for, and they're passing back and forth, all over the world, and like those are just two different use cases, but both powered by stablecoin tech. Or the third option is you just have a handful of consumer-facing brands, and the back end infrastructure becomes too complicated and like doesn't really solve enough problems compared to banking as a service and other ledgers today. And so the end state of stablecoins is there's a handful of consumer-facing brands. Everyone knows what stablecoin they're using, rather than stablecoins are behind everything. Like to me, those are the only like three options. And like, is it both? Is it just one, or is it just the other? And like nobody knows, but like we'll find out in the next 3 years. Like Goldi, your thoughts?
I gotta say one more thing about this topic, and look, I do agree with you, but I think that our challenge as people who are at the front of technology right now in terms of how you can move money in the world is to understand that we're still a small bunch, right? And I think that blockchain hasn't been even baked enough. Even the stablecoin ecosystem that's been blowing up, for me, every day right now is like 100x busier than it was last year. I think for you as well, we were talking about this, Kai, how we're taking now calls with one another as you're, I don't know, brushing your teeth in the morning or something to catch up anymore. But I think that even though we feel this explosion, I still go to companies, really huge companies or large banks, and the conversation starts with, "Can you just tell me 5 minutes? What's a stablecoin?" Right? Just explain the mechanism for me, right? And I think this needs to go through banks. Then it needs to go through service providers that are not just Fireblocks, like service providers that have been out there, like SAP, and have been out there like digital agencies. And then needs to get built into products like SaaS products, like Marqeta, and other types of companies that are doing all sorts of different products for merchants. Then it will reach those merchants. And I think as much as I would want that to happen, yesterday, I think the futures that you've presented, Kai, will happen, but there's like a whole stack that needs to be built before a lot of this will materialize.
So my hypothesis is, if you've ever read the book Crossing the Chasm, that we are still on the way up to the chasm. But the velocity of kind of crossing that 13% of innovators, we're now past the the innovators, we're into the early adopters. And the question then is, does it go all the way? If you look at the rollout of cloud, if you look at the rollout of a lot of the technologies like that, still less than 50% of compute workloads. I guess wild to me that there is still probably so much more growth for the cloud service providers ahead of them than there is behind them. So these things do take an awful long time, and yet they can still be utterly massive. What really matters is their growth rate over time. And we are seeing experimentation, and that's part of the fun of this show. I want to bring in another thing that Standard Chartered's done recently, which is they partnered with OKX to enable off-exchange collateral, from the really big picture stuff to kind of really small picture stuff, but kind of very in the weeds here. The offering is called mirrored collateral, with assets held in custody by Standard Chartered used as collateral for trading on the OKX exchange. And Brevin Howard is one of the first institutions to take part, of course, the parent of Elwood, one of the main trading backend platforms. The collateral is a mix of cryptocurrencies and tokenized assets, starting with Franklin Templeton's tokenized money market fund, and the offering is being conducted as a pilot under the supervision of Dubai's VARA, the Virtual Asset Registry Authority. A lot of names that keep coming up here. VARA, if something new is happening, generally involved. Franklin Templeton, Brevin Howard, Standard Chartered. We've been speaking a lot about collateral mobility. We've been speaking a lot about that sort of stuff. Goldi, your reactions to this?
Look, I mean, you've touched on this when we were talking before. Everything changed post FTX, right? If we go back in time, when FTX collapsed, a lot of the large market makers, a lot of the traders were trapped. And that created a mass movement by, again, those large entities who trade 24/7, who need to hold funds at various exchanges and outlets to actually perform their day-to-day business. It caused them to take a step back and say, hey, wait, we want to be risk off, right? And that caused a lot of solutions within this industry. Copper had a solution. Fireblocks has a solution. Binance created a solution. Everyone, even by the way, the traders themselves were negotiating. I don't know how much people noticed. The traders were negotiating directly with exchanges, and they would have tri-party agreements with banks, very ad hoc, to say, hey, I'm going to trade Binance, but I have an account here. I'm going to let Binance look at this account because I'm not putting money into Binance, right? And that already started 3 years ago. And what you're seeing right now, I believe, is the, two things coming together. On the one hand, again, more and more risk-off solutions as the market's super volatile. People want to trade it, but they want to take a step back. And on the other hand, banks that are coming in and, they actually want to be part of this ecosystem, and they're scratching their heads. You guys have talked about this a lot. How are we making money with this industry? And I want to unpack one last thing, which is Standard Chartered is not a normal bank in the world of crypto, right? They own 50%, I think less. I don't want to get them into regulatory trouble, but they own a bit less than 50% from Zodia Markets and Zodia Custody. You've had Nick Philpott here in one of your episodes talking about this. He mentioned this, and they've been into crypto. They know what they're doing. So this working together with OKX, which is, it's not an entity that's easy to digest globally, by the way, right? It's not like they're operating out of, Washington, D.C. So Standard Chartered doing this is obviously fascinating. It's exciting because they're doing this. And it's exciting because they're doing this with, some companies that have been around the space that they've been financing over the last few years. It's also not exciting at all because it's obvious. You know why it's obvious? Because this is how market structure should work. This is how finance has been working for years. There's prime brokers, there's collaterals, there's margins. You don't deposit $1 billion into an point blank to trade. And for me, that non-excitement is exciting because it means we're maturing, right? So that's my take.
Yeah, I like that. I feel like that's a summary of a lot of the things we talk about on the show. It's non-excitement that is exciting. Making things work as they work today is news in the crypto industry. I think that is a segment, over and over. And I just echo what you said of, Standard Charter, is one of the most sophisticated, banks around crypto. And they've been in the space, for a long time. They've done a lot in the space. I think Zodia, their work with Zodia Markets and Zodia Custody, both of those products, I think are getting significant traction. And I think we're starting to see, we've said this time and time again, that in the next year, you see the difference between banks who have been investing in this space, consistently over, long-term periods of time, with executive, sponsorship, with consistent teams in place, that are now, able to just execute, and they're able to ship, and able to, the things they've worked on are starting to compound, versus if you're scrambling and you haven't been in the space, if you haven't had a team, and now you're trying to stand up your team, and now you're trying to put together your strategy, the time it takes to go from like no focus on the space to a strategy to the execution of that strategy, is a multi-year period, inside of a large institution like a bank. And so I think the only way that Standard Chartered can do this, announce a, OKX, collateral solution where they're, managing custody of tokenized assets, is because they were planning this 2 years ago. Like, they're planning this 3 years ago. They were building the infrastructure, to do that. And so I think that's what we're going to see more and more, is this separation between banks who've been in the space for a while and banks who are coming into the space now.
And because they've been exposed to the Dubai and the Abu Dhabi regulators, because they have major bits of their business that operate out of those financial centers. Same for Singapore, same for Hong Kong. Because they're involved in those trade flows, those money movements, and across intra-Africa, that's where Standard Chartered is very large. They've been exposed to the growth in this, and they've benefited from the growth in it, with regulators that have been more permissive, but also very controlled in how they've moved forward. I challenge anybody to tell me who's dealt with the Monetary Authority of Singapore or VARA that was easy. These are thoughtful regulators without question. So I love that word you used, Kai, about compounded return for financial institutions that have been in that space for quite some time. And I love that point you made, Goldi, which is like, this gets fun for me when it gets boring for the like hype crowd. This is when, from first principles, there's a reason some things in finance work the way they do, because it wasn't that the technology was bad. It was that the solution of separation of duties makes sense from a risk management standpoint. And you can make that go faster. You can make it more transparent. You can make it digital. But you don't solve the risk management problem with technology. You solve it through separation of duties and separation of concerns. So the fact that we're replicating that is probably a good thing. And there's room for experimentation. I mean, goodness, the Bank of International Settlements is playing with automated market makers, and there will be DeFi innovations that come into the biggest institutions in the world. So we'll see that in the near future. And did you want to jump in? Sorry.
No, I just wanted to say on the bid before. I mean, again, we don't have to incorporate this, but this is also a big win for OKX. People need to understand that post Bybit, these exchanges are terrified. This was like what happened with Bybit is a tailored attack of a nation, funded organization that stole $1.4 billion. OKX knows they have a target on their back. When they can actually tell the top traders, hey, we're not going to hold your money, that's a gift for an exchange, right? So don't look at it only from the banking angle. Think about now the exchange can focus on creating the exchange and trading engines, right? Just another take.
All right. I do just have to pause here to hear from our sponsors, and we'll be right back. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is brought to you by Canton Network. Ever wonder where real tokenized asset volume is going? Canton Network. The groundbreaking layer one public chain where traditional finance and crypto are starting to converge. Why? Because Canton is the only public network with privacy. No workarounds, no compromises. This is 24/7 markets, on-demand financing with real yield, where value moves as freely as information on the internet. This isn't just another blockchain. No, this is where the serious money is flowing to solve real market demand and risk. Visit canton.network to learn more. Okay, thank you to our sponsors. The next story is JPMorgan are launching a Connexus-based digital payment in GBP. So this is their internal blockchain bank account service. They had supported dollars and euros, and it, of course, supports 24/7 around the clock FX and payment movement. The first clients to use the GBP movement capabilities are the London Stock Exchange Group's swap agent and commodities trader Trafigura. Connexus has now processed more than $1.5 trillion in cumulative transactions and averages more than 2 billion a day. So whilst people say there's only so much fun you can have with your own blockchain, talk about compounding, Kai, earlier. There's definitely something that JP Morgan's been doing here for a little while. Just the value proposition of 24/7 alone is kind of huge.
Yeah, it seems like JPM coin and this Connexus product is the best example of the most successful tokenized deposit implementation that we've seen from any bank in terms of volume and adoption that they've had. Like doing $1 trillion, like it's clearly solving a problem for their clients. And I think we've seen for many years now, one of the use cases that banks have looked at is it is not particularly easy to move money, for a large bank between clients of that same bank. If you are, global, if you might have multiple, core ledger systems, and so blockchains and even permissioned private blockchains, really I look at it as just it's a new modern ledger that a bank can create a tokenized digital representation of their deposit, and abstract it away from the traditional, core ledger. And if they had multiple, different, disparate core ledgers, if they issue a representation of that deposit on a single global private blockchain, they can then move that money between their own clients, 24/7. They can have some, programmable properties to it. So it seems that it solves a real problem inside large banks like JPM, that is getting adoption with clients. I think what's going to be interesting to see is one, do we now see other banks go down this path to try and replicate these like intra-bank 24/7 systems using permission blockchains and tokenization? I think JPM, standing up and investing in building JPM coin now, I don't know how many years it's been, at least 4 or 5 years, 6 years. Like, so they've been in this space for a while. I doubt that was really easy to get going, particularly during periods where there was a lot of regulatory uncertainty. And if you call something a coin and you're using a blockchain, I would imagine that the scrutiny and kind of what they had to go through with regulators was probably higher than if this was just a core ledger system with no form of tokenization or coin related. And so now that there's more regulatory clarity, does this become a use case that more banks look at standing up 24/7 intra-bank settlement systems using tokenized deposits? And will we see this as a broader trend? I think that's one question. The other question is, like, how do tokenized deposits relate to stablecoins? And from my opinion, it's a separate product with a separate use case. Where here this is intrabank only. Stablecoins are open loop, moving between thousands of entities. Do we see companies or banks like JPM who've been successful with intrabank tokenized deposits look to expand that in some way outside of the bank? Is that the same product? Is it a different product? Do tokenized deposits directly interact with stablecoins? So I think those are the really interesting questions going forward that it's still very unclear, like, will these be developed in parallel? Will they intersect or will they cross over at some point in the future? So Goldi, how do you think about that? We talked about just like, let's assume tokenized deposits and stablecoins are the same, but they're different. And like the different use cases, like what do you see in the distinction between them?
Wow, so much to unpack in this topic. I mean, first of all, to your question, I think the future is in the past, right? I mean, this is again a time where banks have their own money and then they don't, right? Banks had their own money back in 1800 and something, different types of dollar, different types of checks. And then they didn't because they created clearinghouses that made them being able to support one another. And then the Fed came in and all that system, right, that came together. I honestly believe that this tokenized deposit is, it's just the first experiment of many that will happen. You know what? Scratch that word. It's not an experiment. The first product, actually, solution that's happening. Yes, I truly believe there'll be a lot more. I think the globally systemic important banks, the large banks of the world, they will build this on their own. I think, probably the tier down will have to rely on other tech and companies out there doing that. I'm sure, probably some will knock on your doors as well. Kaya, obviously with Visa operating all those banks. I think what's really important to remember here is that this is a bank that has been around since 1871, I think, right? They have 300,000 employees. They're the largest bank in the world in terms of market cap, like $650 billion. They're the fifth largest in asset management of $4 trillion. And they've been doing this since 2019, as you said, right? And kudos to that person at JPMorgan who never stopped believing and pushing that project up until 2025. And and for me, when I see JPM now rebranding, and I see JPM right now in every conference, I've been to Paris last week, Paris Blockchain Week. They were there on like 3 different stages, right? I see them in every conference. For me, it means that they've sort of decided internally, all right, this is not a proof of concept. This is a proof of priority, right? We need to push this to mainstream. We need not only to have an experiment, but to be the largest bank in the world that's running a full production grade system, because that's our role, even though our CEO sometimes says that Bitcoin is the worst thing that happened since I don't know what. And Bitcoin, did sort of invent blockchain. But we're not gonna talk about that. We're gonna talk about how Connexus needs to lead. And I think they're putting that front and center. And yeah, to your questions, Kai, yes, I believe we'll see other banks. Yeah, and yes, I think that within a few years we'll see interoperability, and I think they won't have a choice because this will be the new form of dollar within the U.S. And yes, you're right. Stable coins will definitely still be in existence for outside, probably. But we can go back to this episode in 5 years, see how it grew.
I was going to say, I definitely want to do that. JP Morgan always reminds me of the oil tanker. It's generally heading in the right direction and it's consistent. If JP Morgan has a superpower, it is consistency. They don't give up on things and they keep going. And if it takes a long time for it to turn, that doesn't matter because they're consistent. The compounded impact of this could have been lost 5 years ago when everybody was doing the blockchain, not Bitcoin projects. JP Morgan shipped the Interbank Information Network, which used a blockchain and many privacy preserving technologies to confidentially share information related to risks around a given transaction, which has hundreds of clients that are banks that exist on it. They launched what was Onyx, the payment network, which first it was JP Morgan Coin, then it was Onyx, now it's Connexus. If they can pick a name, then great. Just stick with the name for a little while. But I do believe that HSBC has a similar product, Citi has a similar product. So to your point, the money center banks will have this product because they don't just serve their customers and the global corporates, they serve most other banks as well. So you can move a good chunk of the money flows around the world through one of these money center banks and make an entire business case for a blockchain that is utterly massive based on just that bank. So this is the no-brainer business case that always made sense. If you could just deliver instant 24/7 multi-currency settlement, you had a product that every corporate treasurer and every small institutional bank would absolutely bite your hand off for. The episode we need to do in 2-3 years' time is does all of this merge out towards stablecoins? Is there a domestic use case for stablecoins? Are these flavors of the same thing? How do they ever become interoperable? And we just don't know. But one clue might come from the last story we had today, which I just want to give a little bit of airtime to, which is Kraken are now going to launch stock and ETF trading. So this commission-free equity trading will support over 11,000 stocks and many ETFs. They say as demand for 24/7 global access grows, clients want seamless, all-in-one trading experience. And what I think is interesting about this is while Robinhood has been the commission-free trading experience that does crypto, is talking a good game about tokenization, does 24/7 settlement with stablecoins. Now we have Kraken moving the other way. So the convergence here of these things and it being abstracted away from the user under fintech could be a model or a pattern we start to play out. Or I could just be absolutely losing my mind, like a kitten just playing with a tapestry and unraveling that thing. So Goldi, what are your thoughts?
I think first of all, we gotta appreciate the Cinderella story that has happened here. If you go back in time, let's say I don't know, like maybe 5 years or 6 years, Kraken were raising money because it was hard for them, and I think it was like the second crypto winter or the first crypto winter that was hit really hard, and since then they had fights with NYDFS. They were super vocal about anti-regulation, and they managed really as an exchange, as a product, as a company, to really turn a corner somewhere over the last several years and create massive presence in the industry, especially, by the way, around OTC trades, and retail adoption as they've start to get more into different countries in Europe. And you saw they're announcing more and more partnerships around payments. I think, to your point, Simon, it's almost, it will be very hard to differentiate between a crypto company and a normal, I don't know, fintech or exchange company or trading company, because because to my thesis, we are crossing the chasm, or we have. I know, we'll have to fight that over another episode probably, but I think that part of the fact that we're seeing this is this convergence. And I don't know if it's them fighting Robinhood. If I have to, really bet on something, I think it's actually Kraken need, a bit more, let's call that, not institutional, but like substantial beef, for their client base to actually maybe talk about a liquidation event over the next several years, right? Maybe that's where they're aiming. I don't know about anything specific, but if I were Kraken and I look at Coinbase with the huge appreciation of value that is happening right now, and the fact that everything that we're talking about in this podcast we'll see that manifested probably over the next several years in some of the stocks that are out there. And Coinbase could be one of those lucky ones, right? Maybe. And I believe Kraken wanted to be part of that play again as well. And I think that this acquisition signals to the market, hey, we're not just degens. We actually know how to run a company that talks to retail traders globally. And, we're their house anyway for crypto. Now they can do everything here. We know how to run this business to become a global platform.
Yeah, to me, it just almost feels like you've got Robinhood, Coinbase, and Kraken in the US that are very much like Robinhood started in stocks, is now doubling down on crypto, and hearing things from them in terms of headlines around crypto. It seems like on a weekly or monthly basis. So it's clear they've got an ambition to get more into crypto. And then you've got Coinbase, who we would expect would get closer to traditional equities and tokenized equities. They've talked about a tokenized version of coin stock. And I think it makes sense that Kraken would have a similar approach of taking their strength in crypto. And I think it's interesting that they're entering this space before Coinbase to some extent. And I think they're all well run companies that have a significant opportunity ahead of them. And I think that it'll be interesting to see how they stack up against traditional brokerages over a long-term period of time. And like what the split looks like between crypto and stocks. I think Robinhood, has had periods where they've made more money on their crypto trading than they have on stocks, or at least, it's been a very profitable product. And as I think we're seeing a convergence of both of them, coming together into the same products.
Everybody is doing product expansion in every direction at the moment. We have some very large companies that have broad shoulders, looking for new revenue lines, whether those are using tokens under the hood, whether it's the traditional infrastructure. Customers just want their problem solved, and people who can do it, we should welcome. All right, well, that brings us to the end of the show. I want to thank everybody for watching, for listening. Kai, where can people find out more about you and everything Visa's up to?
On X at Kai Sheffield and visa.com/crypto.
Goldi, how about you?
I'm Rand Goldi on X and Rand Goldi on LinkedIn as well. Come find me, DM me. I'd love to have a small "Did we cross the chasm or not" battle with you guys.
Heck yeah, let's do it. You can find me at SY Taylor on Twitter. Find me, Simon Taylor, on LinkedIn, fintechbrainfood.com, tokenizedpod.com, and of course, sardine.ai. If you haven't already and you're watching, go ahead and click the like button. Go ahead and subscribe. Tell your friends about this show. We're a little podcast that can. We're slowly gaining traction. We would love it if you would share what we do. Thank you so much, and we'll catch you next time.
Thank you, folks. It's been amazing.